Good morning and thanks for joining us. My name is Brandon Kuntz and I'm a Senior Vice President here in the Client Strategies team at Research Affiliates, and I'm focused in particular on multi-asset solutions. It's my pleasure to host this webinar, Forecasting Asset and Portfolio Expected Returns. Nearly 3 years ago, we launched this asset allocation tool, and we did so to help investors avoid chasing past performance, but to instead focus on the future. And after receiving a bunch of feedback, actually over 500,000 visitors came to the website, we've now relaunched this tool on June 15th with an enhanced interface. Along with this enhanced interface, we also have additional functionality. For example, we've incorporated the modeling of more asset classes. We've also incorporated more forecasting for model portfolios. We've even incorporated a new forecasting model, and for those international investors, we've now created the ability to view our return forecasts in 5 different major currencies. Now, with me to share insights around this tool, I have Jim Masturzo, who's a Senior Vice President on our asset allocation team. We certainly hope you find this webinar helpful and informative. And as you know, we tend to try to keep as much time as possible at the end of our webinars for your questions. If you do have questions, feel free to submit those at the upper right-hand side of your screen. Now, before I turn it over to Jim, let me review some high-level survey results from some questions that we sent out for those that had signed up for this webinar today. What you see on the left is our first question, and that is, what is your current asset allocation? And then on the right, what do you believe your current prospects are for achieving 5% real over the next decade? And the takeaways here are that most investors still have a largely kind of domestic-centric portfolio. And there's kind of a split in our investor base around whether or not they feel their portfolios are likely or not likely to achieve 5% real in the coming decade. Hopefully, after the hour that we spend with you today in today's webinar, you can walk away with a better understanding of what the present is offering so that you can think about ways that you can better plan for the future. Now, let me turn it over to Jim to highlight a couple of themes from the webinar, and we'll get to questions from there.
Thanks, Brandon. There's really 3 key themes that we're going to talk about today: reevaluating portfolios, rethinking risk, and recommitting to a long-term perspective. With respect to reevaluating portfolios, for those of you invested in the bellwether US 60/40 portfolio a decade ago, you've enjoyed a fantastic ride, earning in excess of 4% a year net of inflation. Unfortunately, that return has come with a bit of a cost in the form of rising equity valuations, higher PE multiples, as earnings growth has failed to keep up with the price rises that we've seen in the markets. That always leads to the most common question, which is, can this continue? I don't know, but history does tell us it's unlikely. What I do know is that opportunities exist beyond mainstream stocks and bonds to take advantage of asset classes with lower valuations, more attractive cash flows for investors willing to go beyond their current comfort level. We'll spend some time today talking about future asset class returns, but the focus is how do we create portfolios well positioned for the future. Portfolios that are able to meet our future spending obligations. For long-term investors, risk is failing to meet long-term spending needs, regardless of the fact that we often talk about risk in a quantitative fashion as volatility or variance or any of those sorts of things. Finally, recommitting to a long-term perspective is really about recommitting to, or maybe defining for the first time, your investment beliefs. Investing is hard. The market will kick you in the teeth more times than you want to think about. And without investing beliefs, it's difficult to maintain positions in a falling market. It's difficult to sell in a rising market. Or said another way, rebalancing is hard. rebalancing also happens to be one of the few time-tested opportunities for outperformance. So align your incentives with your long-term objectives. Ignore short-term fluctuations and do your best to stay the course.
Thanks, Jim. With that as backdrop, maybe we can switch right into the view of the Asset Allocation Interactive tool. And I'm going to start by asking a few questions that are probably already on top of our investors' minds. First and foremost, for those who haven't already explored the tool, can you take a moment to help orient their eyes on the new interface?
Sure. The AAI tool, or the Asset Allocation Interactive, is the way that we make our expectations publicly available to investors, as well as a set of tools for diving deeper into those expectations and into the return drivers of asset classes. We've recently overhauled it, as Brandon mentioned previously, with a lot more data, more functionality. That comes with a bit of a cost of increased complexity in some cases, especially for those users who might be used to our old system that was relatively simple. So I encourage anyone looking at this or anyone who visits the AAI to just click around, explore. You'll be an expert in no time, and I'm confident that you'll find the enhanced functionality well worth the time it takes to come up to speed. At a high level, there are really four main parts of the screen. On the left here, we have our lists of portfolios and assets. They're collapsed right now for space. Each asset or portfolio is assigned a color. It's important because these colors are reflected across the tool. So equities are always red, core bonds are always light blue, portfolios will be gray or black, depending on your particular screen. The colors might change a little bit, but the point being that those colors are reflected everywhere. If you do expand these, you can then see the list of assets that we have within the tool that are reflected in the Scatterplot, which takes me to the Scatterplot, and that being the main focus of the screen at this moment. So when you look at the tool, your eyes should be directed to looking at this Scatterplot of risk and return, or more specifically, real expected return in US dollars versus volatility. We can change this chart to look at a lot of different things, and we'll do that as we talk this morning. At the bottom, we have a few other smaller charts. Here we're showing correlation matrix, Sharpe ratios. These are meant to be, in some ways, teasers for additional information you might be interested in, and you can pop these up into the main screen to drill in a little bit more in more detail. And finally, on the right, here we see overview text describing our methodology at a high level. This is where we'll see additional information or drill down information into the components of return, portfolio allocations, and the like.
Great. So Jim, I got a question here. I'm looking at the main chart, and it looks like we have an efficient frontier along with all of the other asset classes that we're forecasting. But one thing that kind of blaringly, sticks out at me is this pink dot to the upper left of what I believe is the efficient frontier. Can you kind of explain how that's possible?
That's right. This dotted line represents the efficient frontier with portfolios that are clickable at every 2% volatility, so 12%, 10%, 8%, so on and so forth. This efficient frontier may be different than what some investors are used to, or what you'll see in business school, where essentially an efficient frontier is created as the highest return per unit of risk, assuming point estimates for both return and risk, and completely unconstrained. What we do here is actually add a set of constraints, and those constraints are allocation limits to particular assets. So for instance, we don't want to create a portfolio or show an efficient portfolio that's, say, 100% in, I'm going to use EM cash because that's essentially, or actually what this pink dot is. We want to create portfolios that are more diversified. The other thing we do is that we run a simulation process, a Monte Carlo process, where we create thousands of efficient portfolios based on the fact that our expectations for return are not point estimates, they're distributions. We average those together, we get this frontier here. If we didn't have constraints, here being the EM cash portfolio, we would see an expected return that either went through this dot or more likely was slightly above it.
Gotcha. That's helpful, Jim. So let me though go back to something that you said earlier when we introed the slides, and that is you said that a 60-40 portfolio today is not expected to deliver the 4% plus kind of real returns that we've seen over the last 10 years. Can you use the tool perhaps to elaborate a bit on that thought process?
Yeah, let me just go ahead and click here on the 60-40 portfolio, and when I do that, we'll see this line appear, and the line is the distribution around the point estimate of 0.5% expected return annually for the next 10 years. You asked about the probability of 5% real, and if I come over here in the right rail, and the right rail, as I mentioned earlier, is where we get our additional information. We estimate that the probability of annual 5% real return for the 60-40 portfolio is less than 1%. Very small indeed. We use 5% not because it's a magical number here, but because that happens to be a target for many U.S. pension plans. Your target for your own portfolio may be more or less than 5% real. If we just drill in just a little bit and get a little more detail, I can show you that our 50 basis points of return comes from a set of building block components. The two that are not negligible here are the average net yield of 2.4%. This is simply dividend yields, coupon payments that we're getting from the stocks and bonds in the portfolio. And then we see a negative 1.9%, call it negative 2% valuation change. This comes from our expectation of mean reversion in both fundamentals, so PE multiples reverting more toward their average level, as well as rising bond yields that have been low for a decade now.
So Jim, I'm looking at this right now and I'm seeing 0.5% returns, and I'll tell you that just from conversations with investors in the field, they would probably disagree with that number. Many could point today to the year-to-date returns of a 60-40 portfolio already being probably pretty darn close to CPI plus 5. What do you say to those who perhaps doubt that or have those types of questions?
So let's start with your comment there on the historical return of 60-40, and I believe you referenced year-to-date, so I'm going to go ahead and bring that up for our viewers here. And in fact, you're right, the 60-40 portfolio just this year, or through the end of May, has returned 4.9% net of inflation. A nice, healthy return. If we go drill in just a little bit more, let's take a look at some of the constituents here. Whoops, there we go. The Barclays U.S. aggregate is up 1.2%, so 40% of the portfolio, basically 50 basis points of return. It's contributing to the 60-40 portfolio. If we go over to U.S. large caps, the S&P 500, 7.4% return, so 4.5% contribution to 60-40. In essence, the 60-40 portfolio is getting its return from the spectacular rise in the market just this year. If we take a minute and say, let's move beyond year-to-date returns, let me just look at the last decade. And what we see is the 60-40 portfolio is up 4.3% per year for 10 years. That's fantastic for those that invested a decade ago, who have actually enjoyed almost a 50% cumulative return net of inflation. As we think about the future, though, we don't necessarily at research affiliates think that extrapolating the past is the right way to think about expected returns. In fact, we think that it makes sense to look at fundamentals, and that's how we do our expectations, which is why when I go back to our expected returns here, we drop back to the 50 basis point return. But let's get a little more information on that on the 60-40 return. And what I'm going to do is let's take a look at the U.S. large. And so if we look at the S&P 500, we can see that we actually have an expected return of the same 50 basis points, coincidentally. That comes from three components. As I said, we do not want to extrapolate the past. We want to look at fundamentals, and those fundamentals are the current dividend yield of about 2%, long-term earnings growth at 1.3%. We're slightly under that, and if you read our methodology document, you can see all the nuances, but essentially 1.3% is very close to long-term earnings growth. And again, a huge loss in valuation of almost minus 3%.
Yeah, that seems really high, Jim. I mean, can you explain why do we have such a large negative number for valuation change on U.S. stocks?
Yeah, so as I mentioned in my opening comments, the price changes that have occurred in the market have not, our earnings growth has actually not kept up with the price changes. And we can see that here when we look at the CAPE ratio chart. And the CAPE, for anyone who's not familiar, is the cyclically adjusted price to earnings ratio, or current price divided by an average of real earnings over the last decade. And we see here that the current CAPE ratio in the US is 29.4, not its all-time high, which is about 44 from the tech bubble, but far above its long-term median of 16. If we just do a simple reversion, not of 29 all the way to 16, that may be dramatic. If we just say, let's go from 29 halfway to 16, or call it 21, 22 range, we see our valuation change of about minus 3%. If we revert to 22, 21, we're still high and expensive on a historical basis. But we feel that halfway reversion is a decent assumption.
Okay, so you do the halfway reversion, and that gets you to the 5% real expected returns for U.S. large cap. What about the kind of the Barclays aggregate side of the 60-40 equation? How are you forecasting that?
Let me go ahead and bring that up here. Here we can see that our expectation for U.S. bonds, or the U.S. aggregate, is essentially zero. Actually, you can see it's 10 basis points, but for all intents and purposes, it's zero. That comes from similar building blocks. In fact, all asset classes that we forecast roll up into these three building blocks. We can go deeper by expanding these and get more information, but we're not going to do that today. We'll stick with the top level building blocks. We can see we get 3.1% nominal yield from the index. Because we're looking at real returns, we're going to net out our expectation for inflation over the next 10 years is 2.2%. And then we lose an additional 80 basis points from yields, rising yields, expected movement in the yield curve from its current location to its forecasted location. In fact, we can look at that. So for investors who might be interested in looking at what our yield forecasts are in the next 10 years, I'm going to pick up this chart very easily by using our chart tool here, or our chart list. I point this out primarily because there are a lot of charts within the AI tool, and for investors who found something and maybe you can't find it again, this is just a long list of all the charts you can find, or all the charts that are available, and it's a quick and easy way to find something. So if I just go to our forecasted nominal yield curve, we can see that, and I'll just use the 10-year tenor here. Our expectation for 10-year yield in 10 years is 3.3%. Currently, it's about 2.1, 2.2, depending on the day. So a rise of over 1%, pushing that 80 basis point loss.
Okay, so you've got capital losses from reversion to equilibrium term structures on the fixed income front. You've got capital losses from reversion towards kind of halfway equilibrium valuations on the equity side, and when you put it both together, that's how you get the 50 basis points real for a 60-40 portfolio.
That's right.
What if, like just hypothetically, Jim, what if an investor were to achieve 5% real out of a 60-40 portfolio over the next decade? What would have to happen for those asset classes to deliver in that regard?
So if you're expecting 5% real from 60-40 over the next decade, essentially, and these are sort of large swath kind of things, but essentially what you're saying is that real earnings growth for stocks are going to be if not larger than ever, as large as they've ever been. PE multiples are going to go back to their all-time highs. So think about the PE multiples in 1999 and in early 2000. Bond yields are going to go severely negative, or some combination of those things.
You know, I'm thinking about this, and I'm sure that many of our participants today are saying, gosh, we're talking a lot about a 60-40 portfolio. They probably are already aware that a 60-40 portfolio doesn't look to have very powerful forward-looking prospects, and they're probably thinking that they have a much more diversified portfolio. So what do you say to them?
Sure, that's a fair point. The 60-40 portfolio is excellent for proving a point, but it's not the portfolio that most investors own. So let's choose something that's maybe a little more akin to an average investor portfolio. We have a set of model portfolios here that we create just for that purpose. I'm going to start with the public pension portfolio here and show that this portfolio, which is essentially an average of a lot of different public sources on the average allocations of public pension plans in the U.S., has an expected return of 1.6% with about 9% volatility. Higher than the 60-40 portfolio, about the same amount of risk. If we look at the allocations in this portfolio, what we see is that it's only, I'll actually just scroll down here just a little bit, make it easier to see. It's about 44% in equities, 36% bonds, some credit, and other things. What's interesting to note is that although this portfolio is only is less than actually 50% in equities, if I use the contribution to return chart here, we can see that almost all of its return comes from the equities, though. The diversification in this portfolio is actually providing little in the way of enhanced returns. We'll be getting some benefit from reduced risk, but essentially not a lot from returns.
So what about the average advisor portfolio, though, and not just the public pension?
Sure. If we look at an average financial advisor portfolio, and again, this is an average of a couple of different sources, we see a similar story of 50% equities, more diversification, but diversification without a lot of return benefit.
I'm looking at these two portfolios, and both of them, even though they're more diversified than a traditional U.S.-centric 60-40 portfolio, they're still showing real return prospects over the next decade of less than 2%. It's actually kind of depressing just to see those numbers. And I'm tempted to just use doom and gloom as a strategy, but if I don't want to do that, Jim, what do we do about it?
I'm sorry to disappoint you so much this morning, Brandon, but I think we can actually do a few things. Let's go ahead and close our contribution to return chart here. And this, or answering questions like this, are the real benefit of the AAI tool and what we hope that users of the tool will get out of it and take advantage of. Earlier we talked about the efficient frontier and the diversified portfolios that have the highest return per unit of risk that as we've defined them. So if we look at an average advisor has a volatility of 10.5%, I'm going to simply just choose the 10% volatility efficient portfolio, and we can take a look. We can go ahead and take a look at its allocations, but let's do that in comparison to the average advisor. So we can see that this efficient portfolio has a return of 3.4% real, almost 2% above what the average advisor gets for actually slightly less volatility. And what we see is that the allocations are starkly different, both in the sense of about half as much equities, similar bonds, more credit, and so forth. If we go one level deeper, we can see that one major difference is not just the fact that we have half as much equities, but that those equities are diversified away from U.S. stocks and bonds, which are the hallmark of the average advisor portfolio.
How much does the 10% vol efficient portfolio have in private market asset classes?
That's a good question. So let's scroll down here and we can see that when we look at things like commercial real estate, 6% versus 3, no hedge funds in the 10% vol portfolio, but 7.3% in private equity. So there's, call it 10, 11% in alternative non-public assets.
So I have two questions for you. One is, what is that green thing at the bottom right side of the screen?
So this right here is, you can see it's a cumulative probability of return. This is exactly the same as what we see in the line on the scatter plot. And what it shows is the probability of this portfolio achieving certain levels of return. So 95% probability of eclipsing an 80 basis point return, 75% chance of eclipsing 2.3, so on and so forth, up to 5% chance of eclipsing a 6% real return.
Okay, and then the second question I've got is on the private fund side of things. What if you're an investor that doesn't have access to private equity, hedge funds, or commercial real estate? What do you do about that?
So in that case, it makes sense to start with this 10% volatility portfolio, but let's go ahead and customize it to our liking. And when I click copy and customize, it wants me to give it a name, so I'm going to call this the webinar 10% portfolio. There we go. And once I do that, you'll notice that on the Scatterplot, we now have a webinar 10% portfolio. And as I go ahead and make adjustments to the allocations, the risk and return will update in real time. I'm going to, as you indicated, remove the private markets. So I'm going to zero out the commercial real estate. We don't have any hedge funds. I'm going to zero out the private equity. And so essentially what I've done is taken about, call it 10 or 11% of this portfolio and reallocated it to cash. That moves our risk from 10% down to 8.4. It also drops our return to 2.7. I don't want to just leave that return in cash. I'm going to go ahead and actually just throw it back into the, let's say, the average advisor portfolio, which will pick up some of that US equity exposure that we looked at earlier. And when I do that, you can see that we, actually let me go ahead and save this before I lose it. There we go, and we can now see that we have an expected return of 2.9%, volatility of 9.5% in a portfolio of strictly public markets that most investors have access to.
So I'm thinking out loud here, when you're showing all of these different portfolios, or at least these advisor portfolios and the average public pension portfolios, we're seeing a lot of negative returns coming from changes in valuation. And I guess my question is, why do we see that, and how confident are we that those changes in valuation on the negative side will actually materialize?
It's a question that comes up quite often. The reason we've actually seen negative valuation changes this morning is that the portfolios we've tended to look at happen to be overweight in the most expensive assets. I can assure you there are a number of assets, emerging market equities, even developed market equities, and some others that have positive valuation change. Your question, though, is spot on about the confidence in valuation change. When we think about expected return building blocks, the yield, the growth, the valuation change, we have a lot more confidence in something like yield, basically because it can be observed in the market, so that's an easy one, or growth, where we can look at long-term trends, than we do in valuation change. It's not to say we don't have confidence in valuation change, but it is far less than those other assets. The tool, however, provides a mechanism for someone who might say, you know what, I'm less confident than even you guys are in the valuation change. So I'm going to go ahead and just turn off our portfolio here to go back and show everything. And if I go into models here, in addition to our valuation dependent model, we have another alternative, which is yield plus growth. Many investors are familiar with this as being called the Gordon growth model, as it's most famously known. And if I click that, we can see that now we can look at assets minus their valuation change or minus mean reversion. And to prove a point, if I just click on the US large, we can see that the expected return is no longer 50 basis points, it's up to 3.2% because we no longer have that negative valuation change. This is a way of saying that you believe that prices today are going to, not that they're going to rise, but that they're going to stay constant into the future.
So Jim, do we at Research Affiliates employ one model over the next? Like, which one do we encourage investors to use?
That's an interesting question. And my answer to that, and something I wrote about in the recent article called Cape Fatigue, is that no model is a silver bullet. We don't believe that at all. And so for investors, they have, using this tool, they have a number of different options. You've got the valuation dependent, you've got the yield plus growth, or if you want to, you can create a blend. You can see here I've actually created a blend that's 30-70. I'll show you how to create one very quickly here, and we'll do the, let's just do a 50-50 blend and save it. And what this does is that it says, for investors who might say, you know what, I'm not as confident as you are in your mean reversion and your valuation dependent, but I don't want to totally ignore it. I can just weight the two models together at 50-50, and the expected return for, in this case, US large is a 50-50 blend of what you would get under the two separate models.
So this has been really helpful, Jim. I want to save some time for some questions from our participants, but before I do that, is there anything else about the website or about the new tool that you think would be helpful to review before we jump into questions from the audience?
Sure, let me just highlight two quick things. One I mentioned earlier, and that is the fact that although we've talked about everything in terms of US dollars today, we actually do offer all of this information in 5 different currencies: Australian dollar, euro, British pound, Japanese yen, US dollar. In the future, we'll look to add other currencies as well. And finally, we've done everything today in what's known as portfolio mode. This is simply focusing on a reduced set of core assets with the purpose of creating and analyzing investor portfolios. We have another mode called full asset mode, and when I click on this, you'll see why. In the Scatterplot, we go from the 30 or so core assets to 130 individual assets that we actually forecast. So when we look at something like developed market equities, we actually do our forecast at a country-by-country level. So we can see Switzerland, Japan, US small caps, and the like. When we look at our commodity forecast, we actually forecast commodities individually. Soybean oil, hogs, zinc, and the like. So for investors who are interested in diving deeper and really understanding this next level of expectations and the drivers of these individual asset classes, they can use full asset mode.
This is really helpful, Jim. I appreciate the time today. I know we could probably spend a lot more time going into the different charts and functionalities that we've created, but let's maybe think first and foremost about taking the rest of the time to answer some of our investors' questions. Right. As a reminder to those of you that are dialed in, if you submit questions in the upper right-hand portion of your screen, we can take a look at those, and if we don't get the chance to answer those today, we can certainly follow up later on. Joey's passed me, and Joey's our head of marketing here, he's passed me a question from an investor that says, does forecasting expected returns matter if you don't also forecast expected correlations?
That's absolutely right, and I'm glad that someone submitted this question, because oftentimes we spend so much time talking about risk and return, and actually we spend so much time talking about return that we ignore the fact that correlations are extremely important in creating portfolios. Here we can see that we actually do show our expected correlation matrix. We forecast a correlation matrix using an exponentially weighted moving average approach with a long-term half-life in order to take advantage of recent trends, but also to still incorporate long-term histories. As I roll over it here, you can see the actual correlations. For those who are interested, though, in the numbers and not just the trends that you see in this heat map approach, I would just encourage you to download the information. You can download correlation matrix, covariance matrix, risk and return from in Excel format and then play with them to your heart's content.
So I'm looking at other questions on this list, and there's a couple that are pretty similar. Let me just read them both and get your thoughts on each. One says, what do you believe is the asset allocation that would deliver 5% real return over the next 5 to 10 years? And there's another one that says, is there a long-term but simple asset allocation that gets me to 5%? I want to avoid selling an allocation that appears too complex.
That makes sense. Simple, or the word simple is obviously in the eye of the beholder, but I'm going to interpret the use of simple to mean mainstream or home-biased assets. And to be honest, high valuations in those types of asset classes make simple asset allocation strategies that achieve 5% nearly impossible. Definitely very difficult and nearly impossible. If it weren't for non-U.S. markets, the efficient frontier would be very flat and lower than it is or is here in our display. But there are, the good thing about this is that there are opportunities for investors willing to go outside their comfort zone. Willing to expand into credit markets or commodities or REITs or assets that maybe they haven't looked at in the past. And by the way, we've only discussed passive investments so far today or asset class level investments. Alpha is an important piece of this discussion, especially when you're talking about expensive asset classes. And we're big believers in adding value through contrarian trading, both across and within asset classes. And that's another avenue that we could spend a whole nother hour discussing.
Yeah, so I'm looking at another question here. It's fairly similar, but it says, given policy, governance, behavioral, and investability constraints, is aiming for 5% real even a reasonable target for investors? And before you jump in, Jim, I just wanted to point out there's really two things that we're advocating in the field, and that is that investors now more than ever need to take on more Maverick risk. And what we mean by that is getting away from mainstream markets. And you'll notice that all of these efficient frontiers that we have on this tool show more Maverick risk than what most investors are willing to tolerate. For those that can't tolerate that Maverick risk, they perhaps are inclined or tempted to just increase the volatility tolerance on an absolute level of their overall portfolio. And that's another area where we think that that's kind of a bad approach to achieving 5% real. So admittedly, 5% real is very, very difficult in today's environment. And for those that want to do so, we believe that one, you should approach a Maverick risk approach to investing, but that two, you seek to add value above and beyond passive exposure by allocating to kind of attractively priced contrarian rebalancing strategies within asset classes, or perhaps through allocating to those that are adept at contrarian trading across asset classes.
I completely agree with everything you just said. And as you were talking, I was thinking about even the 14% volatility portfolio that we show here has only a 41% probability of achieving 5% returns. So investors will need to do more to embrace Maverick risk if they want to achieve 5%.
So moving on to the next question here, it looks like it says, please discuss the diversification rebalancing premium in total portfolio return forecasts.
Great. This is a question that we could geek out on for a while, but I'll make it short and sweet. And I'll do that by utilizing the contribution to return chart. So for each of these portfolios, we see the expected return coming from each asset class, and then on top we see this nice brown cap. In this case, for the 14% portfolio, it's 40 basis points of return. This simply captures the fact that the expected returns we show, they're often called geometric returns or median returns. When you create a portfolio, you want to look at at simple returns, arithmetic returns is as they're often termed. This goes back to a long literature starting back with Fama and Booth. So essentially, I'll just leave it at saying that the diversification benefit captures this translation between geometric and arithmetic, and leave it at that. Although we could have a very long and detailed conversation on this.
So I'm looking at a few questions. It looks like there's at least 4 that are along these lines. And by the way, this is reflective of how often I get asked this question in the field. And I'll read a couple of them to you so that you're aware. It says, what is the basis of forecasting asset class returns, and how good is the actual track record of past forecasts? And then there's another question that's similar to that says, how valuable or accurate is forecasting due to the fact that there are just so many unknown and unpredictable variables?
You know, let me answer the second question first and say, yes, there are unknowns. There are always unknowns, but without some sort of forecast, some sort of model, some sort of investment belief, as I mentioned at the outset, it's impossible to make any decisions. So just because there are unknowns doesn't mean that you shouldn't try to calibrate and quantify the things that you do know. On to the first question you asked, which I believe was more around the accuracy of our forecasts and how we measure the accuracy. This is a common question. As soon as you use the word expectation, someone says, well, how good has it been in the past? And it's a fair question. The challenge is that these are long-term forecasts, 10-year expectations. And to be able to actually estimate the value in those 10-year expectations, you have really 2 options. One is to have enough historical data that you have enough decades to measure your model against, or 2, and that just doesn't exist for most of these asset classes, or 2, look back 10 years and say, how did I do with 1 data point? Also not a very good test. Lucky for us, forecasting asset class returns is actually not the purpose of this. It's a means to an end. The end is actually into creating portfolios meant to deliver on investor expectations. I wrote a piece about a year and a half ago. It was called Simple is Not Simplistic. I was never a fan of that title, but I do like the article. And what that article does is it goes in and compares our efficient portfolios versus a number of other commonly used strategies for creating portfolios or creating expectations of portfolios. What we find in the article is that we actually perform very well, partially because we don't extrapolate historical returns in high valuation environments.
So investors can read the Simple is Not Simplistic piece, and of course continue to monitor the results of our return forecast over the next many, many decades before they can have any confidence empirically and statistically that they're sound.
I would also just, yes, that's true. I would also just reiterate something I mentioned earlier about when we talked about multiple models. One of the benefits of having multiple models, and the 2 we have here are highly overlapping, obviously, but in the future we'll add more models, is that this idea of being able to diversify your expectations as well as customize them for your needs. Something I wrote about in the Cape Fatigue article for anyone interested in checking that out.
Yeah, you know, one other thing that comes to my mind on just the accuracy of our return forecasts is that what matters more than anything isn't the accuracy of any individual asset class forecast, but the accuracy of the combination of forecasts that you use to create a portfolio. And if we can be directionally accurate in the combination of forecasts that we have to create a portfolio, then that actually leads to better outcomes, assuming we can use contrarian rebalancing around that anchor point.
That's right. I mean, essentially what you're talking about is diversification, that you want to not just diversify portfolios for the purpose of reducing risk in the future, but for the risk of diversifying, issues that may affect any particular expectation within an asset class.
Good stuff, Jim. Let me look at a couple of these other questions. These are a little bit more on the margin questions, but still similar in terms of their theme. I'll read the next two and see what you think. Does the risk in Europe and the emerging markets outweigh current low PE ratios and favorable forward returns? And then the second one is geopolitical uncertainty factored into country-specific expected return analysis, which ultimately plays into overall asset allocation?
Those are good questions. Questions that, again, we hear quite often. You know, with respect to risks in, say, emerging markets, or let's just say risks outside the U.S. Affecting particular countries, and how that affects, you know, PE multiples, or does that outweigh low PE multiples? You know, if you believe in any sort of an efficient market, you're basically accepting the fact that those risks are priced into the market. Now, so in that case, no, they don't. Low PE multiples have that risk priced in, and we feel that you know, you can. Let me put it this way. Those risks are priced into the market. They're priced into individual country markets, but we wouldn't necessarily, and we won't, encourage investors to purchase particular countries just because they have a high expected return. For instance, I showed earlier that the highest expected return we actually have is for Russian equities, both due to low PE multiples as well as undervaluation in the currency. Now, I wouldn't tell anyone to go out and stake their claim on the Russian equity market, but I might say, or what I would say is, look at an emerging market basket. So if you're worried about individual risks in individual markets, diversify that away. Look at an emerging market basket. Look at a developed market basket, or same thing that goes with currencies and bonds.
You know, I'm thinking out loud here, and I know that this isn't something that's available on this exact interactive tool, but we spend a lot of time thinking about how we can incorporate economic risks by country into our forecasts for individual asset classes, and we do that. And for those that are interested in kind of further details along those regards, you can feel free to reach out to us and talk about how we incorporate kind of business cycles and economic risks into our shorter term forecasting approaches. So look, I think we're about out of time here. Thanks a bunch, Jim, for your thoughts and for your comments here, and certainly for all the hard work that went into the creation of this AAI tool. We've already gotten a lot of good feedback on it, and we certainly appreciate those that are using it and thinking about it in their asset allocation decisions. I will say that for those of you who have submitted a response or a question that wasn't answered in our Q&A section, we have that list of questions, and we will be tasking our distribution team with following up with each and every question. So be on the lookout for that as well. Also, there's going to be a replay of this webinar available on our website at researchaffiliates.com by this afternoon. So if there are those that were not able to make it, it's going to be readily available fairly quickly. And then if you're part of our mailing list, you're going to be notified when all of these materials come available. For those that are not yet subscribed to receive updates to this website or this tool or some of our research papers, you can sign up for the distribution of that material on our website, once again at researchaffiliates.com. Thanks again to everyone who joined and for spending the last few minutes with us. And before you go, we just want to say that we always appreciate feedback. And there's going to be a short kind of 1-minute questionnaire that we have at the end. And we'd love to get some of your impressions about this webinar and how we can improve these types of interactions in the future. Thanks again for being with us today, and until next time.